All right. Top trader says 99% of XRP holders will fail. An incredibly startling claim has just been made about the XRP community. Staggering 99% of XRP holders are on direct path to investment failure. Think about that for a second. Out of every 100 people holding this token in their digital wallets right now, only 1% is predicted to actually cross the finish line and reap the rewards of Ripple's massive global payment system. This isn't just a random guess thrown out here on the internet. This warning comes straight from a top analyst at Cheeky Crypto. But here is the real kicker. The real reason the reason most holders will fail has absolutely nothing to do with market volatility, SEC court decisions, or even Ripple's technology. Instead, it comes down to a silent psychological trap that most investors fall into even into without that most investors fall into without even realizing it. So as a market observer, I have watched countless cycles play out, and today we are going to dive deep into the exact behavioral data behind this warning. We will analyze how incomplete information shapes your decisions and why your daily habits might be setting you up for failure. So let's look at the hard truth behind the numbers. So, why did the top analyst claim that 99% of XRP holders will fail? So let's start by unpacking where this shocking 99% figure actually comes from. In a highly discussed post shared on X, the prominent analyst at Cheeky Crypto stated flatly that the vast majority of retail investors are practically designed to fail in this market. Now, to be completely fail, the analyst quickly clarified that this 99% figure isn't meant to be a precise scientific statistics. Instead, it is a dramatic wake-up call, highlighting a disruptive behavioral pattern that repeats across the crypto space cycle after cycle. They argue that success in cryptocurrency investing is heavily linked to timing, analysis, and risk management. Yet, most retail investors ignore these fundamental pillars, focusing instead on quick, effortless wins. Now, here's my opinion. I completely agree with the essence of this warning. In the fast-paced world of digital assets, people have developed a lottery ticket mindset. They buy an asset like XRP and expect it to make them overnight millionaires. When the market moves sideways or undergoes a healthy consolidation, they lose interest. The 99% figure might sound exaggerated, but it accurately reflects the proportion of people who treat crypto like a casino rather than a long-term venture. If you aren't treating your XRP holdings with the same discipline as a traditional business asset, you are voluntarily placing yourself in that failing category. Now, how does all right? The next question is, how does YouTube watch time prove that investors are losing focus? Right? To back up their claims, the analyst at Cheeky Crypto pointed out an incredible, unusual metric that most investors never think about, and that's YouTube's average view duration. They revealed that highly educational videos, the ones that actually break down on-chain data, utility, and regulatory shifts, only get an average watch time of 30% to 40%. While a content creator might look at that as a standard platform metric, as a market observer, I see it as a massive red flag regarding the retail investor mindset. It proves that the average person has an attention span of just a few minutes before they get bored, skip to the end, or click away. When viewers skip through deep dive videos, they miss the vital tissue that connects a sudden market event with its long-term future implications. They grab a quick headline or a price target and run with it, completely blind to the why behind the movement. Now here's my opinion. This watch time metric is a perfect reflection of why so many people get wrecked here in crypto. We live in an era of TikTok brain, where if a concept cannot be explained in 15 seconds, people don't want to hear it. But deep financial systems like the Ripple ledger cannot be understood in a 15-second soundbite. If you can't sit through a 10-minute video explaining the mechanics of cross-border liquidity, how can you expect to have the mental fortitude to hold an asset through a multi-month market correction? Skipping the details is a shortcut straight to making poor financial decisions. Now, why does missing the broader context lead to panic selling? When you consume only fractional pieces of information, you create a dangerous gap in your knowledge base. Cheeky Crypto explained that this lack of full context directly feeds three of the biggest portfolio killers in existence. And those are the fear, boredom, and flat-out misunderstanding. Right? Without a solid understanding of the macro picture, a retail investor looks at the daily chart and sees nothing but stagnation. They see XRP hovering around its support levels, and because they preferred rapid timeline isn't being met, they assume the project is dead. They look at a single negative headline and let fear take the wheel, completely ignoring the massive structural and institutional integration happening behind the scenes. Ultimately, this incomplete picture convinces them to sell their positions at a loss, right before the actual utility-driven demand kicks in. Now, here's my opinion. It is incredibly painful to watch retail investors sell their XRP because they are bored. Boredom is actually a sign of healthy accumulating market. When an asset is consolidating, the smart money is quietly building positions, while impatient retail investors are selling out of frustrations. I always say that if you don't know why you own an asset, you will find any excuse to sell it when the price drops. If you only read headlines, you are letting the market's mood swing dictate your financial future. You have to look past the daily noise and focus on the plumbing being built beneath the surface. Now, how can we break free from the outdated retail mindset? What makes this behavioral issue even more frustrating is that it isn't new. The analyst Cheeky Crypto observed that average video watch times and investor habits have remained almost entirely unchanged over the last several years. Even as the cryptocurrency industry matures into a highly regulated, institution-backed asset class, the average retail participant is still trading like it's 2017. They are chasing short-term hype rather than adapting to the new reality of utility-driven markets. To make matters worse, changes in social media, recommendation engines, and artificial intelligence have actually reduced the organic reach of highly educational content. This means finding deep, high-quality analysis requires more personal effort than ever before. If you want to survive, you have to actively seek out the complete picture rather than waiting for it to be spoon-fed to you on your feed. Now, here's my opinion. The market has evolved, but the average investor has not. We are no longer in an era of pure speculation where any random meme coin can pump 10,000% in a single tweet. We are moving into a highly structured financial landscape where utility, regulatory compliance, and institutional partnerships are what drive sustainable value. If you are still relying on the same hyperactive, impatient trading habits from years ago, you are bringing a knife to a laser fight. Breaking free from this mindset means turning off the 1 minute charts, reading the actual documents, and letting your investments breathe. Now, is patience truly the ultimate filter for crypto success? At the very core of Cheeky Crypto's video is one timeless theme, and that's patience. The crypto market is essentially a highly efficient mechanism designed to transfer wealth from the impatient to the patient. When you look at the sheer scale of Ripple's global partnerships, their ongoing central bank digital currency or CBDC projects, and their focus on real-world asset tokenization, it becomes clear that this is a long-term play. Yet, the vast majority of holders will shake themselves out of their positions long before these multi-year initiatives reach full maturity. They will let a temporary price dip or a quiet macro environment convince them to move their capital into some other volatile asset, only to watch XRP take off without them. The analysts emphasize that the key to avoiding this fate is to study the information in its entirety, absorb the full context, and give your investments the runway they need to perform. My opinion is that patience is not just a virtue in crypto. It is a literal survival mechanism. I've seen so many people sell their XRP at a loss out of sheer impatience, only to buy back in a much higher price once the FOMO or fear of missing out kicks in. It's a vicious cycle that destroys portfolios. You have to realize that institutional adoption doesn't happen overnight. It takes years of regulatory alignment, technical testing, and infrastructure building. If you aren't willing to match your investment horizon with the development horizon of the technology, then you are simply playing a losing game. And finally, here's our overall conclusion. When we piece everything together, the warning that 99% of XRP holders will fail isn't a prediction of XRP's downfall. It is a mirror held up to the retail investor community. The technology behind the XRP ledger is stronger than ever, and its institutional utility is undeniable. The weak link in the chain is human behavior. If you are constantly skipping through educational content, relying on sensationalized headlines, and letting short-term price action dictate your emotional state, you are actively aligning yourself with the 99% who are bound to fail. To step into the elite 1% of successful investors, you must change how you consume information. Stop looking for shortcuts. Embrace the slow grind of actual research and give your assets the time they need to mature. The choice of which statistics you belong to is entirely in your hands. This finally ends our video. Thank you very much for watching and see you on the next one, or you might just as well check this next recommended video right here.